All right, so you're trying to figure out where to put your money right, RRSP or TFSA. Well, stick with us for this deep dive and we'll help you figure it out. We're going to be breaking down these two really popular investment accounts here in Canada. And did you know, if you've never opened a TFSA, but you were eligible to wager, you can have like $95,000 in contribution room. Crazy, right?
Yeah, it is pretty crazy. And you know, that's a really great point to start with. Both of these accounts, the TFSA and the RRSP, they let your money grow protected from taxes.
Yeah.
But they each have their own way of doing it. With the TMSA, it's all about not paying taxes when you take your money out. So you put in money you've already paid tax on, and then when you take it out, you don't have to pay any more tax.
Okay, so it's like this little haven where your money grows and the government can't touch it.
Mm.
But how is that any different than an RRSP? With RRSP, you get to like lower your taxes right now, right?
Exactly. So with an RSP, you put money in and you get to lower your taxes this year. But then when you take the money out, you have to pay taxes on it. Ideally, though, you'd be taking that money out in retirement.
So it's like you're pushing your taxes down the road. And hopefully when you retire, you'll be in a lower tax bracket, so you'll pay less tax overall.
Exactly. That's the idea. It's all about timing.
So, okay, let's talk about the actual numbers here. What are the contribution limits for 2024?
So for a TFSA, it's $7,000. And don't forget that any room you don't use just gets added on to the next year. With an RRSP, it depends on how much you make. You can put in 18% of your income up to a certain limit that the government sets.
Okay, so if you make more money, you can put more in your RRSP. But what if you're just starting out and you don't have a ton of extra cash to be investing?
That's where the TFSA can be really useful. Even if you can only put in a little bit, it still grows without being taxed. And you can always take that money out if you need to.
So it could be for a vacation or even retirement. That's pretty cool. But what if something comes up and you need to use that money, like an emergency or something?
Well, that's another area where the TFSA really shines. You can take your money out anytime and you won't be penalized. And your contribution room won't be affected either.
Wow. Okay, so that's a lot better than having your money locked up until retirement. But what about people who are specifically saving for retirement? Does the RRSP make more sense for them?
Well, it depends. Yeah, it really depends on your specific situation. Remember that with the RRSP, you can lower your taxes today. So if you're in a high tax bracket now, that can really make a big difference. And then when you take the money out in retirement, hopefully you'll be in a lower tax bracket, so you'll pay less tax overall.
Right. That makes sense. But what about people who are thinking about, slowing down at work or even retiring soon?
That's a great question. And actually, an RRSP can be really helpful in that situation too. As you start working less, your income will probably go down. And that means you'll be in a lower tax bracket. So that's a perfect time to start taking money out of your RRSP.
Oh, so you're kind of like planning ahead with your taxes, taking advantage of being in a lower tax bracket later on.
Exactly.
But what if you need that money from your RRSP before you retire?
Well, it's not really ideal. You can take it out, but you'll have to pay taxes on it. And you'll lose that contribution room forever. It's really best to think of an RRSP as money for retirement.
Right, like a long-term savings plan.
Yeah.
But what about unexpected expenses that come up before retirement, like medical bills or something like that?
Well, that's why it can be really helpful to have both a TFSA and an RRSP. That way, if you need money for an emergency, you can just take it out of your TFSA. No penalties, no taxes, nothing.
So it's like having a safety net and a retirement plan all in one. That's pretty awesome. But can you actually contribute too much to a TFSA?
Yeah, you have to be careful with that. There are limits to how much you can contribute each year.
Yeah.
And if you go over, you can get hit with some big penalties. But the good news is that the CRA has a website where you can track your contribution room, so you always know how much you can put in.
Okay, that's good to know. And what about RRSPs? How do you know how much you can contribute?
You can find that information on your notice of assessment from your taxes. Or you can also check the CRA website. And if you're ever not sure, it's always best to talk to a financial advisor.
That's great advice. So we've talked a lot about the accounts themselves, but what about the actual investments you can hold in them?
Oh yeah, that's where things get really interesting. With both TFSAs and RRSPs, you have a lot of different options. You can invest in stocks, bonds, mutual funds, ETFs, all sorts of things. You can actually build a whole portfolio within these accounts.
Wow, so it's like having a whole investment world inside these accounts. But does it matter which account you choose for different investments?
Absolutely. It all comes back to how these accounts are taxed. For example, let's say you're investing in stocks that pay dividends. Those dividends are considered taxable income.
Okay, so where would those dividends be better off? In a TFSA or an RRSP? So if you hold those dividend-paying stocks in a TFSA,
Yeah.
you get to keep all those dividends without paying any tax on them. It's like a double win.
Right.
You get the growth of the stock and then the extra income from the dividends,
Yeah,
and it's all tax-free.
that's right. You got it. It's a really good example of how choosing the right account can really boost your returns. Now, on the other hand, let's say you're investing in something that will give you capital gains, like if you sell a property or some stock for a profit. Those gains are also taxable. But in that case, an RRSP might actually be the better choice.
Wait a minute, why would you want to put something that's going to be taxed in an account that's specifically for retirement?
Because remember, with an RRSP, you're hoping to be in a lower tax bracket when you retire. So even though you have to pay taxes on those capital gains, you'll be paying them at a lower rate. It's kind of like getting a tax break.
Oh, I see. It's all about thinking long-term and trying to pay the least amount of tax possible. This is getting pretty complicated, though. Do you have any advice for people who aren't, financial experts?
My best advice is to talk to a financial advisor. They can help you figure out all the details of these accounts, and they can create a plan that's specifically designed for you and your goals.
That makes sense. It's like having a personal trainer for your money. Speaking of which, do you know any good financial advisors?
Well, you could always check out milestonesfinancialgroup.ca. They have a team of really experienced advisors who can help you with all kinds of financial planning.
Perfect. So if any of our listeners are looking for some expert help, that's the place to go. Well, I think that about covers it for our deep dive into TFSAs and RRSPs. Hopefully you learned a few things and you're feeling a bit more confident about choosing the right account for you.
Yeah, absolutely. And remember, there's no right or wrong answer here. The best choice for you will depend on your own individual circumstances. Keep learning, keep asking questions, and keep growing your financial knowledge.
Couldn't have said it better myself.